Um, as Renee said, my name is Jason Leavitt. I'm going to quickly introduce myself, but since I only have 45 minutes to talk, I'm going to do a quick intro and then get to my material. As she said, I started trading in '99 and then went full-time in 2002. Since then, I've been completely independent and on my own, just trading my own account. My background is as an engineer, but I've never worked on Wall Street, and I've never worked on Wall Street. I've never worked for a prop firm. I've never worked for a hedge fund. I'm entirely self-taught. I've read a lot of books, read a lot of stuff online, but most of what I've learned has come from executing thousands of trades over the years, being very objective, seeing what works, seeing what doesn't work, and essentially playing Monday morning quarterback. Make a trade, see how it worked, what could I have done better, what should I have done, and then you just build your knowledge and experience that way. I get invited here to talk for 45 minutes, which is enough time to explain a really important concept, but not enough time to get into a lot of stuff. So I'm going to treat it like this. I'll tell you a little story, and it'll be an indication of how I'm going to treat this this talk. My brother used to work on the floor of the Merc. He eventually moved up to a screen. He befriended a kid there, a guy named Daniel, who was a really good trader. He was a trader from London. He was like 10 years older than my brother. He was a really good trader. And it was a good person for my brother to befriend because Daniel was older, wiser, had been around the block a few times, and had a really good track record. But the thing is, Daniel had trained a lot of traders, and my brother noticed that a lot of the guys he trained actually made more money than Daniel. And my brother, not being very shy, asked him flat out, like, how come so many of these guys that you trained are actually better than you? You know, they make more money. And Daniel laughed and he said, that's because I didn't teach him any of my bad habits. And so that really hit me that, you know, I've been trading for a long time. I've had a lot of trades, a lot of years and a lot of trades under my belt. And so I get the opportunity to present to you, but I'm only going to tell you what I think is the absolute minimum that you need to know in order to become successful. And I can't talk about everything because I only have 45 minutes, but that's essentially my plan here is to not give you a laundry list of things to do. I'm not going to tell you everything, but there's one particular concept that I really want to hit hard on, which is universal in a lot of different areas. It exists in trading, and it exists in business, it exists in sports, it exists in gambling. And successful people know about it, but unsuccessful people don't seem to know about it, okay? So this is going to be somewhat of a no-holds-barred talk, okay, about what it really takes to make money. Some of you may dismiss what I'm going to talk about. Others of you may have a light bulb go on, okay? If you're new, I hope this sets you on the right path, because this is something that took me many years to figure out, okay? And if you've been around for a while, you've traded, you've made some money, you've lost some money, but you can't quite seem to get over the hump, I hope what I say today turns on a light bulb and enables you to get over the hump, okay? I'm not going to try and sell you on any particular trading style, because I know there's many ways to trade, and there's many principles to use. But what I'm going to talk about today, as I said, exists in pretty much anything that would be considered a performance activity. What I'm going to talk about today exists. Okay? Typically, in this type of setting, you get some guy who gets some so-called guru who comes here, and no question, he's smart, he's well-read, he could pull material from the internet, and he puts together a nice presentation. That's not what this is going to be. I hopefully will tell you something that maybe you've kind of sort of thought about it yourself, but you never actually took the last step to execute it. Maybe it turns on a light bulb, maybe it gives you an aha moment, I don't know. But I'm pretty sure that I'm probably gonna piss off a few people, and that's perfectly fine, because well, because I'm not here to sell you anything, I'm just gonna tell you how it is. All right, so let's get started here. All right, so you know who these guys are, right? Okay, Warren Buffett and his right-hand man, Charlie Munger. Buffett is arguably the greatest investor in history, and if he's not the best, he's in the top 2 or 3. It really doesn't matter. A lot of people think he got wealthy by investing in high-quality companies at discount prices and just reinvested the dividends, and he let compounding work its magic. But this isn't true. Okay, after he got wealthy, that's how he maintained what he had, but that's not how he got wealthy in the first place. Here's a quote from Munger. He said, if you took our top 15 decisions out, we'd have a pretty average record. It wasn't hyperactivity, but a hell of a lot of patience. You stuck to your principles, and when opportunities came along, you pounced on them with vigor. Okay. Notice he didn't say the S&P was up 12% a year and we averaged 15% a year, and that extra 3% per year added up over 50 years. Okay. He didn't say they got started at an early age and therefore have had more time for compounding to work as magic. Okay. He didn't say anything about having great insight into how to evaluate a company as if he knew something that others didn't know. Okay. Instead, he said it was only 15 investments that made the difference. Okay, think about that for a second. Okay, the difference between possibly being the greatest ever and average was only 15 investments over the course of 50 years. Okay, that's a heck of an admission. Here is the track record of a hedge fund. Okay, it doesn't matter which hedge fund it was. It was a hedge fund that it's still in business today. This is this track record starting in 1988 through 2015. This hedge fund has completely destroyed the S&P 500. It's outperformed by a pretty wide margin. Okay, during the time that this hedge fund has been in business, okay, starting in 1988, the S&P 500 has moved from, and I'm going into the end of 2015, not until current prices. So during the time that this hedge fund has been in operation, the S&P has moved from 247 to over to 2043. Okay, during the same exact time, this particular hedge fund went from 247 to over 16,000. Okay, so it completely destroyed the S&P. Okay, but if you remove the 7 best months, okay, and that's what this chart is. It actually has the return every month for I don't know how many years this is. I think it's like 27 years. If you took out the 7 best months, his return drops to 1827. Okay, so the difference between crushing the S&P and underperforming the S&P was only 7 months out of over 300. Okay, that sounds a lot like what Charlie Munger said when he admitted if you took out their top 15 decisions, their performance would be very average. Okay, and that's what this next slide is. Another guy, okay, and I promise this is all gonna tie together in a few minutes. Okay, you know who this is. He's George Soros. He's in Warren Buffett's league. Okay, although Buffett is more of a private equity guy who buys entire companies, Soros is more of a pure trader. He had a lot of traders work for him over the years. One of the best and well-known is a guy named Stanley Druckenmiller. Druckenmiller said the following. He said, the way to build your long-term returns is through preservation of capital and home runs. When you have tremendous conviction on a trade, you have to go for the jugular. It takes courage to be a pig. Okay, notice he didn't say the way to build wealth is to have some sort of an edge. Okay, he didn't say the way to build wealth is by having a high winning percentage, or to consistently beat the market, or to make more in your winners than you lose in your losers, or to have a positive net expectancy. He didn't say anything about a Sharpe ratio or some other goofy statistical measure. Okay, he said the way to build wealth is through preservation of capital, which comes in 2 forms. One, you only trade the best opportunities, okay? Not the average ones, not the so-so ones, not the mediocre ones, only the very best opportunities, and you keep losses small, okay? The second is you hit home runs, okay? George Soros likes to say, press the accelerator. Every once in a while when you get a great opportunity, you have to go for it. So think about it. Being a great trader or investor is a 2-step process. 1, preserve. 2, swing for the fences. Okay, 1, trade only the best opportunities and never let a small loss turn into a big loss. And 2, when you get a great opportunity, you have to go for it. You have to do what George Soros says, which is press the accelerator. Now, if you're listening carefully, you've noticed the similarities between Druckenmiller and Munger. Munger said a hell of a lot of patience, okay, which is his way of saying wait for a great opportunity. And then he said pounce on them with vigor. And I do spell that right. Okay. He said pounce on them with vigor, which is his way of saying when you get a great opportunity, you have to go for it. Okay. You can't just take an average size position. You really have to go for it. Okay. Druckenmiller also said this. He said the few times that Soros has ever criticized me was when I was really right on a market and didn't maximize the opportunity. Think about that for a second. The only time Soros ever criticized him was when he was really right, but he didn't swing for the fences. He didn't get mad when he lost money. He didn't get mad when he made a mistake. He only got mad when he got a fat pitch and didn't swing for the fences. Okay, how many of you have bought a stock at 20, sold a couple weeks later at 24, and then 6 months later the stock was at 40? Okay, and you thought to yourself, you thought to yourself that at the time you sold at 24, you probably should have been looking for a place to add. And then when the stock legged up again, at the next logical place that you could have taken profits, again, you should have been looking to add. And this continues on. So instead of making 4 points in a month, or a couple weeks or a month, you could have made 20 points with 3 times as big of a position. Okay, we've all been there. Okay, I remember I had to trade very early on. It was early 2000. I bought 10,000 shares of a stock at $2, and a month or so later I sold it at 4, so I made 20 grand. I was pretty new to trading, so 20 grand was a lot of money to me back then. Okay, but a year later the stock was up at 15, so I made 20 grand, but I could have made 130. And that's when it really hit me that, like, in that year I didn't make 130 a year. That was my first full year trading. I didn't make 130 grand trading that year, and it hit me really hard that I could have just done that one trade and been better off financially than having actively traded all year. Okay, it's a lesson that stuck with me. Okay, a couple bucks here, a couple bucks there, they add up. But the big money is made identifying great opportunities that come along every once in a while and then milking them for everything they're worth. One really good trade can make your entire year. That's what these guys are talking about. They're not saying you have to have more winners than losers. They're not saying you have to, make 3 points in your winners and lose 1 point in your losers and let the law of large numbers play out. They're saying, one, preserve capital by either keeping losses small or passing on the mediocre opportunities, and two, every once in a while when you have a great opportunity, you have to press the accelerator. Okay? This is a lot different than what most traders attempt to do in this business. Most traders fall into the consistency trap. They want to be consistently profitable. Okay? You don't. Trust me, you don't. Because if you try to be consistent, you'll do trades that are average or below average, and then when you get opportunity, your position size will be too small and you're likely to exit too soon. Okay? Let me move on to the next one. One of my favorite books, one of my favorite trading books is a book called The Phantom of the Pits. Okay? It's not really a book, it's more of an interview between a guy who traded in the pits in the Chicago pits for like 30 years, and one of his, I don't know if I'd call him as an employee or just a fellow trader. I heard this book sold for like $1,000 back in the late 90s, but nowadays you can get it online for free. So you can just go do a search and you could download the PDF. The book is not necessarily well done from a literary standpoint. It's not necessarily well written. Definitely could use some editing, it could use some cleaning up, but there are a couple nuggets in there that are absolutely dead on. The Phantom, as he calls himself because he wanted to be anonymous, has a couple rules. Okay, one is to cut losses, and two is to add to winners. When he enters a position, it's only a starter position, and he assumes it's going to be wrong. Okay, if it's wrong, he gets out, but if it's right, he adds to his position. So when he's wrong small, and when he's right with bigger size. Okay, does this sound familiar? Does it sound like Munger and Druckenmiller, where they said preserve capital and then press the accelerator? Okay, Munger's a private equity guy who buys entire companies. Druckenmiller's a pure trader who traded various markets. The Phantom is a pit trader in Chicago who traded bonds and futures. 3 guys among the best in the world at what they do, yet independent of each other, they all have the same underlying philosophy. Yet you go online and some guru on the internet is going to tell you that he's back-tested some strategy that has a 70% win rate, blah, blah, blah. Like, who are you going to listen to? Are you going to listen to some of the best traders ever and use the philosophy that they use, or are you going to listen to some guy on the internet who you don't know and has no track record to speak of? A lot of you guys probably recognize this guy. He's Peter Brant. He's known for making an average of like 40% a year for about 40 years. Okay, maybe it was 41 years. I don't know. It doesn't really matter. But the thing is, he didn't actually make 40% a year. In fact, most years he didn't make much at all. The S&P would be up 10 or 12%, and he'd make 5. And the next year he'd make 2%. And the next year he'd lose 2%. And then out of nowhere he'd make 600%. Okay, the average over 40 years was like 40%. But it would be very misleading if you believed it and actually attempted to duplicate it. Okay, Brant has an incredible long-term track record because he never had a big down year. Okay, I think his worst down year was about 6%, and he had a small number of years where he totally knocked the ball out of the ballpark. Okay, that's it. That's how he made his money. Okay, that's how he was able to have such a great overall track record, by never having a big down year and by knocking the ball to the ballpark every once in a while. Okay, does that sound familiar? It probably sounds pretty familiar to the guys who have already been talking about. Okay, Munger says have patience and then pounce on opportunities with vigor. Okay, that's what Brant did. Drunken Miller said preserve capital and hit home runs. That's what Brant did. The Phantom says cut losses and add to winners. Okay, all these guys who are totally independent, not related to each other at all, for all I know, never even knew each other, they all somehow came up with the same philosophy that the way to make money is to have patience and selectively pick only the best setups and keep losses small, and then turn around and every once in a while when you get a good opportunity, you swing for the fences. Okay, I think you're starting to see a theme here. Okay, but every financial planner in the country will talk about consistency. They'll talk about diversification. They'll talk about reinvesting dividends or compounding. Yet the best investors did the exact opposite. The best investors preserved capital and passed on mediocre opportunities, and then every once in a while, when they were offered a great opportunity, they totally jumped at it. Okay? I'm essentially arguing that chasing consistency is a trap. You'll travel down the road for 6 or 12 months and realize your results are okay or decent, but not great. And it's only when you fully embrace the concept of lumpy returns that you could truly build wealth. Okay? Your mindset in the two cases is different. Case one being trying to be consistent, and case two embracing the concept of I'm going to lay low and then every once in a while I'm going to swing for the fences. Your mindset is very different. If you're trying to be consistent, you're thinking that you have to make 10 trades and 6 or 7 have to be winners and 3 or 4 are going to be losers, and you need to make more money on your winners than you lose on your losers. But if you follow the path that the guys have been talking about here, you won't do 10 trades. You only do 5 because you'll pass on the mediocre ones. And the fact that 3 or 4 are small losses or winners probably won't bother you, because there will be one really good one that's working well for you, and you'll add to that one and you'll milk it for everything it's worth. Okay, follow me? Okay, you can see the difference here. The guy chasing consistency needs to do a lot of trades so the law of large numbers can work in his favor. The type of trading I advocate allows you to sit back, relax, and say, I only need 1 or 2 good trades this month, or this quarter even. Okay? And this is how the best traders operate. Okay? This is how the best hedge funds operate. Okay? Anyone who trying to be consistent is actually too hard. It's almost, unless you're a really good short-term day trader, I think trying to be consistent as like a swing trader is actually too hard. It requires you to constantly make really good decisions, which is not easy. Okay, let me show you some examples outside of trading, just to show you that like the principles that I'm talking about here are not. It's not just trading. They're universal. They exist in business. They exist in sports. They exist in gambling. Okay. This guy's name is Chris Sacca. He's the founder of the most successful seed fund in Silicon Valley. Okay, he's not actually located in the valley, but most of his investments are there. His return on investment of one of his funds, he's got several now, was something like 280x. Okay, to put this in perspective, if you would have invested in Amazon at its low, which was in 2001 during when the dot-com bubble was bursting, and you held all the way until today, you'd have a 160x return. Okay, but this is just one stock. This guy's entire portfolio is up 280x. So the question is, how did he do it? Did he have great insight, such that he can listen to 100 pitches and pick the one company that was destined to be a great success? It wasn't that. Okay, his winning percentage, or even the number of big winners he's had, is no better than any other fund in the valley. He was able to achieve his high success by doing one thing, and that is he added to his winners. He had 2 huge wins. Okay, one was Twitter. The other one is Uber. The other one is Uber, which isn't public yet. Okay, he invested in both those companies along with dozens of others. But what set him apart from other investors is he noticed those 2 companies were doing the best, and when he was given the opportunity to invest more, he totally jumped at the opportunity. Okay, in fact, he invested in these companies he invested in companies many times. And then when each of the companies grew to become multi-billion-dollar companies, boom, that's how he was able to get his 280x. Okay, so I've talked about a lot of traders here who have used this principle of essentially lay low, have a bunch of small losses, and then every once in a while have a huge win. Is exactly how this guy became one of the most successful venture capitalist investors in history, is that he had a lot of investments and he noticed which ones were doing the best and he pressed the accelerator on those. Okay? How many of you have had good investment and then sold for a great profit several months later, but then realized that although you made good money, you could have made much more if you would have doubled or tripled your bet? Okay? It's happened to all of us. Okay? Chris Sacca doesn't have one of the most successful funds in history because his winning percentage was higher than other firms. He's one of the most successful firms because he added to the couple investments that were doing really well. Okay, as George Soros would say, he pressed the accelerator. This is Tony Hsieh. He's the CEO of Zappos. Okay, he's almost a billionaire today because he did exactly what Chris Sacca did. Okay, Hsieh started a software company in the 90s and made a lot of money selling it to Microsoft. He then started investing in startups. He invested in a handful of companies, and he noticed one of the companies was doing the best and seemed like the most fun to be around, and that was Zappos. He eventually pushed his way all the way into the company and became CEO, where he played a key role in building the company up until it sold to Amazon a few years ago. Okay. Most of his net worth can be attributed to the fact that he identified the bet that was doing the best and he added to it. Okay. He didn't have more winners than losers. He had one big winner, which he kept pushing, and that became a massive winner, and that one trade is responsible for most of his wealth. Okay. This concept of laying low and then having a big winner every once in a while exists in gambling, and I think poker and blackjack are both, although they're kind of gambling, they're not completely gambling because there are odds and probabilities involved. They're both really good analogies for what truly good trading is. Okay. With poker, how do you play poker? Okay, you certainly don't sit down and think you're going to win every hand. Okay. Heck, you don't even think you're going to win half the hands. Instead, you think about folding when you don't have good cards and pushing it when you do. Okay, sound familiar? The game starts and you have a starter bet. Okay, if you're dealt crappy cards, you fold. Okay, you keep your loss small. But if you have good cards, you add to your bet. Then the dealer flips over a few more cards. Okay, again, based on the cards you have and the cards available on the table, you make a decision. You either fold or you add to your bet. Even if you don't play poker, you still know how the game works. It's such a perfect analogy for trading. If you have good cards or sense a good opportunity, you add to your bet and keep pushing it. If you don't, you fold and you keep your losses as small as possible. Okay, sound familiar? This is exactly what the fandom talked about. He said, keep losses small and add to your winners. Okay, your winning percentage could be way under 50%, but as long as you do this, you can still outperform the market by a wide margin. Blackjack is also a great analogy. Okay, if you play the basic strategy, and the basic strategy tells you exactly what to do in all situations. For example, if you have a 13 and the dealer is showing a 7, what do you do? Or if you have a pair of 5s and the dealer has a 9, what do you do? If you play the basic strategy, the odds of you winning are less than 50%. Okay, for reasons I don't need to get into. But if you recognize that if you have a pair of aces against the dealer's 6, you could split them and double down, and you can make enough on one hand to account for many losses. Okay, and you can take it a step further. If you count cards and the count is in your favor, you're probably starting off with a bigger bet to begin with. Okay, so if you just play straight up and bet the same on every hand, over time your odds of winning are very small. But if you vary your bet size and are selectively aggressive when you have a great hand and the dealer doesn't, you could win. Okay, so the essence of great blackjack playing is you bet the table minimum when the odds are against you, in order to keep the damage to a minimum, and then when you get a great opportunity, you press the accelerator. Okay, again, this should sound familiar. Here, got a few more things here. Another quote from Charlie Munger. Okay, he said, "A few major opportunities, clearly recognizable as such, will usually come to one who continuously searches and waits with a curious mind, loving diagnosis, involving multiple variables. And then all that is required is a willingness to bet heavily when the odds are extremely favorable, using resources available as a result of prudence and patience in the past." Okay, there's a lot of stuff in this quote. Let's read it backwards. Okay, he said, using resources available as a result of prudence and patience. This means by only taking high-quality setups, not the so-so ones, not the mediocre ones, just the high-quality ones, you'll have money available when a good one comes along. Okay. He said, a willingness to bet heavily when the odds are extremely favorable. Okay, so when you bet, so when you get one of those really good ones, you don't just take an average position, you size up. Okay, not at once. Okay, your initial position could be a starter position, but as the trade goes in your favor, you could push it a little bit and add to your position. You press the accelerator. Okay, and finally, he says, a few major opportunities. Okay, he didn't say constantly trade and have more winners than losers. He didn't say make more on your winners than you lose on your losers. He didn't say have an edge and then do 10,000 trades and then let the law of large numbers work in your favor. Okay, instead, he said, with money available from being patient and selective, you bet big only on a couple of major opportunities. Okay, should I do one more to point home? Here's a quote from Richard Dennis. He's another legendary trader who's made hundreds of millions of dollars. I think he was profiled in one of the Market Wizards books. He said, you have to minimize your losses and try to preserve capital for those very few instances where you can make a lot in a very short period of time. What you can't afford to do is throw away your capital on suboptimal trades. Okay? This is a totally different guy, completely unrelated to any of these other guys, yet he's saying the exact same thing. Preserve capital and keep losses small so that when you get a once in a while opportunity, you can totally jump at it. Okay. I've spent a lot of time on this because it's super important. Okay. If you're gonna try to trade, whether you're beginning or whether you've been doing it for a few years, your mindset determines kind of like how you operate, and it's really important at the beginning to determine what your path is going to be. Okay, if you're a day trader, you probably could try and be more consistent, but if you're more of a swing trader, you're looking to milk something for everything it's worth and sell it, it's really important that you that you attack the entire activity correctly. Okay, it's really hard to be consistent. Okay, so again, I've spent a lot of time on this because it's a lot important. I really want to pound it in. The essence of good trading and investing is not getting consistent results. It's not having a high winning percentage. It's not using all the computer power out there to develop a strategy that will work 53% of the time, okay, and therefore produces good results over the course of 1,000 trades. It's not making more in your winners than you lose on your losers. Okay, that might be a little bit true, but not in the same way that most people talk about. The essence of good trading is keeping losses small and pressing the accelerator when the opportunity comes. Okay. Most people know about keeping losses small. When you get involved in trading, one of the first things you hear about is you got to use a stop. You got to keep your losses small. Never have a big loss because then you're in a big hole to climb out of. But nobody preaches the importance of pressing the accelerator every once in a while. Okay, this is key. Okay, so many sources will say if you have more winners than losers and make more in your winners than you lose on your losers, you'll be very successful. While this is somewhat true mathematically, it's pretty much impossible to achieve because you're not going to make 3 points in every winner while you only lose 1 on each loser. Okay? The reason I've spent so much time on this is because your mindset is drastically different whether you attempt to be consistent versus if you try to nail a big one every once in a while. If you're trying to be consistent, you will likely overtrade and chase many average or below average setups. But if you're just trying to nail one big one every once in a while, you'll constantly ask yourself, is this one of those big ones? Is this one of those big ones? You'll find yourself sitting and waiting instead of being at the edge of your seat feeling guilty you aren't active enough. Okay? You see, if you're always trying to make money, you're constantly at the edge of your seat thinking, what do I do, what do I do, what do I do? But if you're just looking for one really good one each month, each couple weeks, whatever your time frame is, your pulse drops because you're focused on quality instead of constant activity. Okay? I'll end with this. Okay? The essence of good trading is not to have more winners than losers. Okay? It's not making more in your winners than you lose in your losers. It's not having an edge. Okay? Instead, the essence of good trading is preserve capital, okay, by only taking the very best setups and keeping losses small. Okay? And every once in a while, when you get a great opportunity, you have to press the accelerator by adding to your bet. Okay? After trading for 16 years or so, I can tell you this is such an important lesson. There have been many times I've sat back and said, instead of doing 20 trades, if I would have just done those 5, I would have been much better off. Or I'd say, those couple trades were working really well, and I held them and I milked them and I did well, but if I would have added to my position a couple times, I would have totally knocked the ball out of the ballpark. Okay? I made good money, but I didn't make great money. This is a hard business to succeed in. If you try to make 3 points on your winners while limiting your losers to like 1 point. Okay, it's really hard. The constant decision making, the consistency required is really hard. Okay, if you learn how to have a really big winner every once in a while, you have much better odds of being successful. Okay, that's all I have. That's all I have. Given that I was only going to present for like 45 minutes, I didn't plan anything else other than this. My goal here was to have some sort of a paradigm shift in your mind, because most traders, again, they come into trading and they think, I have to be consistent. I have to find some sort of a setup that works. I need to back test it. I have to be confident that it works 56% of the time. Then I have to execute 100 trades, and the law of large numbers will work in my favor. And that's not how the best traders operate. Okay, whether it's Buffett as a private equity company, whether it's Druckenmiller trading futures and bonds, whether it's the Phantom in the Pit, whether it's Peter Brant, all these guys embrace the idea that the true essence of good trading is not to be consistent. It's to preserve capital, and then every once in a while when you get a really good one, you push it, and then you make more on that one trade than you lost on 20 others. Okay, it's the way it's the way all great traders operate. Some more to a degree than others, but it's how they all operate. Okay. With that, it seems like I'm cutting my time a little bit short here because I've talked pretty fast. I'll throw it back over to Renee, or I'll take questions if there are some.
If anyone has any questions, feel free to ask them for Jason, since he does have a few more minutes if he wants to.
I don't see any questions. I think I could probably find a trade example. Since I have a couple minutes, I could probably find a trade example of something I've done this year, just to serve as an example. Let me see. So here's an example. I'm assuming you can still see my screen. I grabbed this chart a month ago. This was one of my better trades of the year. I bought ABX at 7.5, actually in the end of December, and I sold it for 20.75. It's a perfect example of the entire group was turning up. The entire group had started looking better on its monthly chart and its weekly chart. So I go inside the group and I find a stock that looks good. This one looked good. It was outperforming its peers, and I think relative strength is very important. I was long the stock at 7.5. And then you can see here it ran up, it pretty much doubled. Then it moved sideways for for about 5 or 6 weeks, allowed the 50-day moving average to catch up. Once it caught up, it legged up again. When the 50 catches up, there's your opportunity to add to your position. You can add your position when the 50 catches up, or you can add to your position once a range is established. You can buy at the bottom of the range. It runs up again, moves sideways for about a month. Again, the 50 catches up. It establishes a range, and the 50 catches up. Then it runs up again, and then it flattens out. And I end up getting out at, I think it was 20.75 or 21.75. I don't even remember. I didn't get out at the top, but it's a good example of the group was strong. This was one of the stronger stocks in the group, and I was in early. I got most of the move. And there were a couple obvious places to add because each time it legged up, it moved sideways for a month or 6 weeks, allowing a key moving average to catch up to it, and then it legged up again. It's a perfect example of you get in with a starter position, you add to the position, you add to the position, add to the position probably again somewhere in the middle of July, and then when you put in a lower low and it looks like it might be getting tired, then you start looking for a way to get out. Oftentimes, if you add to a stock several times, your very last add ends up being a loser. Okay, that's just the way it is. If you want to milk it for everything it's worth, the very last add because you don't know when it's going to end, the move is going to end, so you keep adding and keep adding and keep adding, and eventually when that last ad becomes a loser, you end up getting out at a small loss there, but obviously you make a lot of money overall. Okay. When I started trading, I would buy this and I'd probably sell it on the first impulse move because I wanted to take a quick 10 or 15 or 20%. As I progressed, I realized I have to milk it for more, and once it entered this range, I would sell it and be really happy with the fact that I doubled my money. But then when I really started getting into this idea that you have to really push it, when you get a really good opportunity, you can't just make a little bit of money. You have, okay? It's like a baseball player coming up to bat with the bases loaded and hitting a sacrifice fly. Okay, it's good, but like the bases are loaded. You know, hit a double or something, hit a home run, and that's when I fully embraced that, is when my returns really took off. Okay, so in early, added a couple of times. Last ad ends up being a small loss, but overall, instead of having a position, you know, instead of having an average size position which makes a couple of points, or even an average size position which makes a lot of points, I had a bigger position which made a lot of points, and so overall my profit was much bigger. Okay, so now I think my time is running down. I still don't see any questions there unless I'm looking in the wrong place. So with that, I will throw it back over to Renee.